Do you know why one of the world's oldest trading nations, home of the City of London, the Industrial Revolution, and more accountants and cafes, finds it so hard to help its small businesses grow? Picture Britain as a grand old house. Solid bricks, famous address, incredible history. But inside, the wiring is temperamental. Flip one switch and the kettle works. Flip another and the lights dim across the entire street. Small businesses live in that house. And when they try to add an extra room, the floorboards start asking philosophical questions. This story matters now because small businesses are not a side note. They employ most private sector workers in the UK. They anchor towns, stabilize households, and quietly connect Britain to global supply chains, from US finance to European regulation to emerging market manufacturing. When they struggle, the effects ripple outward like a teacup dropped on a marble floor. No drama, just cracks you notice later. Before we begin, do the sensible thing, like subscribe and ring the bell. The funding squeeze, capital everywhere, except where it's needed. Britain is not short of capital. It is one of the most financially sophisticated countries on earth. Pension funds, insurance pools, global investors, sovereign wealth flows. Money circulates constantly. And yet, for the UK small business owner trying to expand, capital behaves like a polite dinner guest who never quite makes eye contact. Historically, British banking evolved to protect stability rather than encourage experimentation. That instinct served the country well for generations. But after the 2008 financial crisis, caution hardened into something closer to institutional anxiety. Risk models tightened. Lending criteria narrowed. Relationship banking quietly faded away. What replaced? It was a system where numbers mattered more than narratives. For a small business, especially one without property assets, this shift was devastating. Expansion requires borrowing. Borrowing now requires collateral. And collateral, in Britain, increasingly belongs to someone else. The overlooked contradiction is that UK banks are not hostile to small businesses. They are indifferent. Capital is not withheld out of malice, but redirected toward lower risk, higher certainty destinations. Large firms with balance sheets, real estate, and legal teams absorb the lion's share. Venture capital exists, but it clusters geographically and sectorally, circling technology hubs like moths around a very expensive light bulb. A family-run manufacturer in the Midlands may be profitable, stable, and well-managed, but to the financial system, it remains opaque. Unknown, therefore unsafe. Who benefits from this arrangement? Established corporations, asset-heavy firms, and financial intermediaries who profit from moving large sums between familiar hands. Who loses? Small businesses that form the backbone of employment and local economic resilience. In the United States, regional banks still play a meaningful role in relationship lending. In parts of the global South, informal finance fills gaps when formal systems fail. Britain sits in an awkward middle ground, too formal for flexibility, too cautious for experimentation. The deeper, systemic truth rarely discussed is that Britain's financial architecture is optimized for preservation, not expansion. It protects what already exists exceptionally well. But growth, especially small-scale growth, requires tolerance for uncertainty. Without that tolerance, expansion becomes an act of personal risk rather than economic strategy. And for many owners, risking the family home to fund a second location feels less like entrepreneurship and more like gambling with a roof over one's head. High operating costs, when survival eats the growth budget. Commercial rent is the most visible pressure, and it tells a story far bigger than property prices. Over decades, Britain tied long-term financial security to real estate. Pension funds invested heavily in commercial property. Insurance companies followed. Property became less about use and more about yield. For small businesses, this transformation turned shop space into a financial instrument with delusions of grandeur. Rent reflects global investment expectations, not local purchasing power. A shop may serve a modest town, but its rent is priced for international balance sheets. Energy costs add another layer. Britain liberalized its energy markets earlier than much of Europe, exposing businesses more directly to price volatility. When global shocks hit, bills rise fast. Relief, when it comes, arrives slowly and selectively. Insurance premiums climb. Business rates remain stubbornly complex and geographically uneven. Each cost on its own seems manageable. Together, they form a quiet chokehold on expansion. Historically, small businesses could absorb higher costs by growing incrementally. One more staff member, one more location. Today, expansion magnifies exposure. A second premises doubles rent risk. Additional equipment multiplies energy costs. Growth no longer smooths expenses, it amplifies them. The numbers often look acceptable on paper and terrifying in reality. Who benefits from this structure? Asset owners, institutional investors, and sectors insulated from day-to-day volatility. Who loses? Businesses that rely on physical presence, local footfall, and predictable overheads. In the U.S., larger internal markets and cheaper commercial space offer some relief. In emerging economies, informality and flexibility soften cost pressures. Britain again occupies the middle ground, regulated, transparent, and unforgiving. The deeper truth is that operating costs in the UK increasingly function as a filter. Only firms with sufficient buffers, scale, or external backing can expand comfortably. Others survive, but cautiously, choosing stability over ambition. Growth becomes a luxury rather than a strategy. Staffing shortages, the quiet mathematics of a changing workforce. For years, the UK relied on a flexible labor supply shaped by migration, part-time work, and sectoral mobility. That system allowed small firms to adjust staffing without long-term commitments. Brexit altered mobility. The pandemic reshaped priorities. Older workers retired earlier than expected. Younger workers reassessed work-life balance. None of this was sudden. It was cumulative. The result is a labor market that still functions, but with friction where fluidity once existed. Wages have risen, which is economically healthy and socially necessary. But small businesses operate on margins thin enough to read through. Higher wages mean higher national insurance contributions, pension obligations, and training costs. Expansion requires hiring, and hiring now requires confidence not just in demand, but in sustained affordability. For many owners, that confidence is hard to summon. Who benefits from this environment? Large employers with predictable cash flow, structured career paths, and the ability to spread costs across scale. Who loses? Small firms competing not only on pay, but on security. In the U.S., labor markets adjust more aggressively through wages. In emerging economies, informal employment absorbs shocks. Britain's system prioritizes protection. Red tape, growth as an administrative event. Britain's regulatory culture evolved to prioritize fairness, safety, and standardization. These values underpin trust in markets and institutions. But when a small business expands, it crosses invisible lines that trigger new obligations. Employment thresholds introduce additional reporting. Turnover thresholds alter tax treatment. Data protection rules expand with customer reach. None of this is punitive by design, but together they turn growth into an administrative event. Historically, regulation assumed scale. Large firms were expected to comply because they had departments dedicated to doing so. Small firms were expected to remain small. Expansion disrupts that assumption. Owners suddenly find themselves responsible for health and safety audits, pension auto-enrollment, data compliance, and employment law nuances. Time spent navigating regulation is time not spent selling, innovating, or resting. Who benefits from this system? Compliance professionals, consultants, and established firms with institutional knowledge. Who loses? Entrepreneurs whose expertise lies outside paperwork. In the U.S., regulatory enforcement varies by state and sector, offering pockets of flexibility. In emerging markets, enforcement is uneven, sometimes dangerously so. Britain offers consistency, but consistency is expensive in attention. The overlooked contradiction is that regulation is meant to enable confidence. Consumers trust British businesses because standards are high. But when standards scale faster than capacity, growth stalls. Owners delay expansion not because they oppose regulation, but because they cannot absorb it without losing focus. The deeper truth mainstream coverage misses is that red tape does not kill businesses outright. It exhausts them. Expansion becomes something to be postponed until things calm down. Tax pressure, when growth quietly changes the rules. Tax in the UK rarely announces itself loudly. It appears politely with letters, thresholds, and phrases like, "You may now be required." For small businesses, expansion is not just about earning more. It is about crossing invisible lines that change how every pound behaves. Historically, the UK tax system was designed around stability and predictability. That worked well in an economy dominated by large employers and long-term corporate structures. Small businesses were expected to remain small, supplementing rather than driving growth. Over time, that assumption became outdated, but the architecture remained. VAT thresholds are a classic example. Below the line, life is simpler. Above it, pricing, accounting, and customer relationships all change at once. Growth does not arrive gradually. It flips a switch. Corporation tax, national insurance contributions, and employer pension obligations interact in ways that are logical individually and bewildering collectively. For a business operating on tight margins, expansion can mean higher turnover but lower retained earnings. The numbers look better from the outside and worse on the inside. It is entirely possible to work more, manage more people, take on more risk, and in the year wondering why the bank balance feels oddly unimpressed. Who benefits from this structure? Businesses already large enough to smooth tax impacts across scale. Firms with accountants embedded into strategy rather than consulted in emergencies. Who loses? Growing businesses caught between simplicity and sophistication. In the United States, tax complexity exists, but scale often brings deductions and incentives that reward expansion. In parts of Europe, subsidies cushion transitions. In emerging economies, informality delays the tax conversation entirely. Britain again occupies a precise middle ground, transparent, rule-bound, and surprisingly unforgiving. The overlooked contradiction is that the UK celebrates entrepreneurship culturally while taxing it structurally. No hostility, no conspiracy, just systems designed for a different era. The deeper truth is that tax pressure does not discourage ambition directly. It encourages hesitation. Owners learn to grow carefully, pause frequently, and consult spreadsheets. Economic uncertainty. Expansion in a world that won't sit still. Over the past decade, British businesses have navigated Brexit adjustments, pandemic disruptions, supply chain shocks, energy volatility, and monetary tightening. Each event alone was manageable. Together, they reshaped expectations. Planning horizons shortened. Confidence became conditional. Expansion, once a forward-looking decision, became a calculated risk requiring multiple exit plans. Historically, Britain thrived as an intermediary economy, linking capital, trade, and regulation across regions. That position remains valuable, but exposes the country to external shifts. Tied closely to U.S. financial cycles, influenced by European regulatory standards, and integrated into global trade, the UK absorbs shocks from all directions. Large firms hedge, governments buffer, small businesses adapt quietly. Who benefits from uncertainty? Firms with scale, diversification, and access to financial instruments. Who loses? Businesses dependent on stable demand and predictable costs. In the U.S., domestic market size absorbs volatility. In emerging economies, flexibility and informality cushion change. Britain offers neither extreme. It offers order, which works best when conditions are calm. The overlooked truth is that uncertainty does not freeze businesses outright. It slows decision-making. Owners delay hiring, postpone expansion, and renegotiate leases cautiously. Growth becomes something to revisit next year. which arrives carrying its own surprises. The deeper systemic reality is that small businesses act as shock absorbers for the economy. They adjust first, suffer quietly, and recover last. Expansion in such an environment requires optimism strong enough to override recent memory. Many owners, understandably, choose resilience over reach. Limited access to new markets, global opportunities, local constraints. Expanding into new markets is often presented as the logical next step. In practice, it is a technical exercise in patience. Britain was a trading nation defined by reach. That legacy remains in infrastructure and expertise, but access is uneven. Large firms maintain export departments, currency hedging strategies, and legal teams fluent in international compliance. Small businesses rely on enthusiasm, spreadsheets, and guidance documents written with impressive thoroughness and limited mercy. Exporting introduces complexity immediately. Customs documentation, rules of origin, regulatory alignment, currency risk, and payment security all arrive at once. For firms accustomed to local trade, the learning curve is steep. Mistakes are costly. Delays are common. Confidence erodes quickly. Who benefits from this structure? Multinationals and firms already embedded in global networks. Who loses? Local businesses with competitive products but limited administrative capacity. In the U.S., a vast domestic market delays the need to export. In emerging economies, regional trade blocs sometimes simplify access. Britain's post-EU position requires navigation without the safety net of scale. The overlooked contradiction is that global markets are more accessible digitally than ever, yet administratively more complex. Selling online is simple. Delivering profitably is not. The deeper truth is that market access is not just about demand. It is about systems. Without support that translates complexity into action, expansion stalls. Digital gaps. When efficiency requires an instruction manual, digital transformation is often described as inevitable. For small businesses, it is also expensive, confusing, and strangely personal. Technology promises scale without proportionate cost. In theory, software replaces manual effort, data improves decisions, and online platforms extend reach. In practice, implementation requires time, training, and tolerance for error. Systems rarely integrate smoothly. Updates arrive unannounced. Cybersecurity concerns hover quietly in the background. British small businesses adopted technology pragmatically. Only what was necessary. Expansion now demands more. Accounting software, inventory management, customer relationship tools, compliance systems. Each solves a problem while introducing another login. Who benefits? Firms that invest early and correctly. Technology providers. Consultants. Who loses? Owners learning systems after hours, wondering when they became IT managers. In the U.S., scale spreads costs. In emerging markets, mobile-first solutions leapfrog complexity. Britain again stands between, capable, cautious, and unevenly equipped. The overlooked truth is that digital gaps are not about resistance. They're about sequencing. Small businesses adopt technology reactively, not strategically. Expansion amplifies inefficiencies before efficiencies materialize. The deeper systemic reality is that growth now requires digital competence alongside financial and operational strength. Without guidance, many owners delay, waiting for clarity that rarely arrives. Risk aversion, when survival becomes the sensible strategy. Risk aversion in the UK is often misunderstood. It is not a lack of ambition. It is the result of lived experience. Historically, British small businesses were built to endure rather than dominate. Many were family-run, community-anchored, and designed to pass steadily from one generation to the next. Expansion was optional. Survival was essential. That mindset did not disappear with globalization. It adapted. After repeated economic shocks, caution became not just emotional, but rational. The overlooked truth is that UK small business owners shoulder disproportionate personal risk. Loans frequently require personal guarantees. Property is often used as collateral. Failure is not abstract. It is domestic. Expansion means tying business decisions to personal security. In such an environment, risk is felt at the kitchen table, not just in the balance sheet. Who benefits from widespread caution? Stability itself. Employment that persists through downturns. Communities that avoid sudden collapse. Who loses? Aggregate growth figures and productivity metrics that policymakers admire from a distance. In the United States, cultural and legal frameworks distribute risk more broadly, making failure less personally catastrophic. In parts of the global South, informality limits exposure. Britain again sits in the middle, formal, personal, and unforgiving. There's a quiet irony here. Policymakers often urge small businesses to scale up. Owners, meanwhile, have learned that staying manageable preserves sanity, health, and sometimes marriages. Expansion promises more revenue, but also more stress, oversight, and vulnerability. For many, the calculation is simple. Enough is enough. The deeper systemic truth rarely acknowledged is that risk aversion is not a psychological flaw. It is an economic signal. It tells us that the cost of failure is too high relative to the reward of growth. Until that balance shifts, ambition will continue to express itself cautiously. Support that feels distant, help that exists but not at eye level. Support for UK small businesses exists. It is sincere, it is extensive, and it is strangely exhausting. Historically, Britain's centralized expertise, advisory services, grants, and development schemes were designed to be comprehensive and accountable. Over time, layers accumulated. Responsibilities shifted between departments, local authorities, and agencies. The result is a landscape where assistance is available, but navigation requires stamina. For a small business owner already managing operations, staff, compliance, and finances, accessing support feels like a separate project. Eligibility criteria are precise. Application windows are narrow. Language is formal. The process favors those with time, familiarity, and confidence in bureaucratic environments. Who benefits from this structure? Firms with dedicated administrative capacity. Consultants who specialize in unlocking support. Who loses? Owners who assume help is not meant for them. In the U.S., support often flows through tax incentives and local banks. In emerging economies, development finance institutions intervene more directly. Britain's approach is measured, cautious, and distant. The overlooked contradiction is that support is designed to reduce risk, yet accessing it often requires risk, time investment without guaranteed outcome. Many businesses quietly opt out, choosing certainty over possibility. The deeper systemic truth is that the UK does not lack policy tools. It lacks translation. The gap between intention and experience undermines trust. Growth support remains something people hear about rather than use. The documentary closes not with collapse, but with stillness. The UK economy is stable, credible, and orderly. Its small businesses are resilient, skilled, and careful. They do not fail en masse. They simply expand less than they could. That is the unsettling takeaway. Not that growth is impossible, but that the system rewards endurance more reliably than ambition. If this analysis helped you see beneath the headlines, subscribe. If it challenged assumptions, comment. And if it felt uncomfortably familiar, you already understand more than most economic debates ever reveal.